As the U.S. markets are closed for the weekend, we have the final print from Friday, November 14th, 2025, for Pfizer. The stock, ticker PFE, ended the session at $25.85. This was a significant move down, dropping 70 cents 5 cents on the day, a decline of 2.73%. This wasn't a low-volume drift either. This was a statement. Trading volume was heavy, clocking in at over 96.5 million shares, far outpacing its recent daily averages. The stock was under pressure all day, opening at $25.67 and hitting a low of $24.97 before finding a slight bit of support into the close. This heavy selling into the end of the week tells a story of conviction, and it's not the one that long-term holders wanted to hear. And here is the immediate insight that you probably won't see in the headlines. That 2.73% drop wasn't just about general market weakness. It was a direct, visceral reaction to the news that Pfizer just cut its ownership stake in its pandemic-era partner BioNTech by more than half. This move, a 54.7% reduction in its holding, completely overshadowed what was supposed to be the good news, the closing of its major acquisition of Metsera, a company deep in the obesity and metabolic drug space. The expectation was that buying into the hottest sector in pharmaceuticals would be a catalyst. The reality is, the market saw Pfizer cashing out its old winning lottery ticket to fund new expensive bets, and it interpreted that as a sign of financial pressure, not strength. This is the central tension in Pfizer stock right now. The desperate, expensive hunt for new growth versus the staggering, imminent collapse of its old revenue streams. Let's establish the common ground, the general belief that is formed around Pfizer. For the last 2 years, the narrative has been that Pfizer is a value trap. It's the ultimate show-me stock. Here you have this global pharmaceutical behemoth, a name that became a household word, and yet the stock has been an absolute wealth destroyer for anyone who bought in after the pandemic highs. A $1,000 investment 5 years ago is worth less than $700 today. Many investors, especially those doing self-investing on platforms like the Robinhood app or SoFi Invest, look at the low price-to-earnings ratio, which sits in the single digits, and compare it to the S&P 500's average in the 20s. They see that massive 6.8% dividend yield and think it's a safe place to park cash and wait for a recovery. This is the expectation. A cheap, high-yield, defensive healthcare stock that is just biding its time. But the reality is far more complex and, frankly, more precarious. The challenge to that safe value idea is that the dividend and the low PE ratio are based on earnings that are, in large part, disappearing. The company is walking straight off a cliff, and that cliff has a name: the 2026 to 2028 patent expiration wave. We are talking about $17 billion to $18 billion in annual revenues from massive blockbuster drugs like the anticoagulant Eliquis, the breast cancer treatment Ibrance, and the prostate cancer drug Xtandi. All of them are set to face generic competition. That $17 billion hole is what keeps institutional managers, the ones using sophisticated interactive brokers trading platforms and managing Fidelity wealth management accounts, awake at night. They know that this revenue doesn't just dip, it falls off a table, often by 80 or 90% within 2 years of generic entry. This isn't a show-me story, it's a replace this story. And the price tag for replacement is proving to be astronomical. This brings us back to the recent brutal stock movement. The market isn't just looking at that 2.73% drop in isolation. It's part of a much larger, volatile pattern. Just a few days prior, on November 10th, Pfizer stock actually popped 4.1%. But why? It was a technical, sector-wide rotation. Investors were dumping high-flying tech like Nvidia stock and Apple stock, concerned about AI valuations, and they blindly piled into safe value sectors like healthcare. Pfizer was a beneficiary of that dumb flow, not a recipient of newfound fundamental belief. The smart managers at Fidelity, who run some of the largest Fidelity mutual funds, saw this as an exit opportunity. The pop was the expectation. The subsequent slide, including Friday's 2.73% drop, is the reality setting back in. The stock is now dangerously close to breaking below its 200-day moving average, a key technical level that often separates long-term uptrends from downtrends. A sustained break below that $24.50-ish level could trigger a new wave of automated selling from Schwab Intelligent Portfolios and other robo-advisors that use technical signals for their online investing strategies. The institutional holdings data confirms this deep divide. While some passive Fidelity ETFs have to hold Pfizer due to its index weighting, the active managers are voting with their feet. Recent filings show that major players like Wellington Management and Morgan Stanley have been significantly reducing their positions. They see the writing on the wall. They understand that management's recent actions, while necessary, are expensive and laden with risk. First, Pfizer spent $43 billion to acquire Seagen, a massive bet to become a leader in oncology, specifically in antibody-drug conjugates. Now, they've just closed a roughly $10 billion deal for Metsera after a heated bidding war with Novo Nordisk. Why Metsera? Because Pfizer's own in-house obesity drug candidate, danuglipron, failed in development earlier this year. They had to buy their way into the single biggest therapeutic market of the next decade, a market projected to be worth over $150 billion because they couldn't build it themselves. This is the classic Pfizer playbook: buy what you can't build. It's what they did with Warner Lambert to get Lipitor and with Wyeth to get Prevnar. But this time is different. The Metsera deal, while strategically vital, is expected to be dilutive to earnings per share all the way through 2030. Think about that. The company is telling their investors that this solution will hurt the bottom line for the next 5 years. So when the market sees Pfizer simultaneously selling its BioNTech stake, its last real tie to the pandemic-era windfall, it sends a clear message. The cash from the boom is gone, and now they are selling assets to fund these long-dated, dilutive acquisitions. This is why the stock sold off. It was a sell the news event, where the reality of the cost and the dilution completely overwhelmed the long-term strategic promise. This isn't the kind of simple, clean growth story you see with Tesla stock. This is a messy, complicated, bet-the-company turnaround play. So what does Pfizer actually do, besides buy other companies? It is, at its core, a legacy biopharmaceutical developer and manufacturer. It has a massive global sales force and a diverse portfolio, for now. That portfolio is split. You have the legacy business, which includes the drugs falling off the patent cliff. You have the pandemic business, Comirnaty and Paxlovid, which has seen its revenue collapse from over $50 billion at its peak to a fraction of that, with 2025 guidance suggesting it's now just a minor, low-growth contributor. And now you have the new business, which is almost entirely built on the Seagen and Metsera acquisitions. The entire future of the company rests on the hope that the new oncology and obesity drugs can get through trials, get approved, and scale fast enough to fill that $17 billion hole that the patent cliff is about to create. All while the IRA, the Inflation Reduction Act, is simultaneously putting downward pressure on its drug pricing. This brings us to the future outlook, the ultimate clash between expectation and reality. Management has put on a brave face. They've raised their full-year 2025 adjusted EPS guidance to a range of $2.90 to $3.10. They are executing a massive $4.5 billion cost realignment program to prop up margins. The expectation they are selling is one of disciplined execution. We are cutting costs, we are buying growth, and our dividend is safe. The dividend is the last remaining pillar holding up the stock price for many retail investors, many of whom are looking for investment help or using investing sites to find high-yield opportunities. But the reality of the scenarios ahead is stark. The bull case is that the Seagen integration is flawless. Its oncology pipeline over-delivers, and the Metsera candidates prove to be best in class, allowing Pfizer to capture a significant share of the obesity market. In this scenario, the company successfully navigates the patent cliff and the stock re-rates higher. The bear case, however, is much darker. The bear case is that the integrations are messy. The new drugs from Metsera and Seagen face trial delays or regulatory hurdles, and the revenue from Eliquis and Ibrance collapses even faster than projected. In this scenario, the $4.5 billion in cost cuts isn't enough. The company's earnings and free cash flow plummet, and that safe 6.8% dividend comes under serious threat. If that dividend is cut, the last remaining prop for the stock is gone, and the value trap snaps shut. This is what the credit agencies and the large institutional sellers are worried about. They are looking at the company's debt load after these massive acquisitions